Hello, traders and investors, and welcome back to Explain the Charts. Today, September 14th, 2025, we're dissecting the USDCAD currency pair, a fascinating cross-section of two major economies. We'll combine the latest news with in-depth chart analysis to give you a clear picture of what's happening and what might come next. The biggest market movers right now are the looming interest rate decisions from both the Federal Reserve and the Bank of Canada. The Bank of Canada is widely expected to announce a 25 basis point rate cut on September 17th, driven by what analysts describe as fragile domestic economic conditions. Just last week, the Canadian dollar saw a notable rebound. This was largely a reaction to new U.S. economic data, specifically higher jobless claims, which reinforced the market's expectation for a Federal Reserve rate cut next Wednesday. So, on one hand, we have the Canadian dollar gaining traction recently due to U.S. data weakening the case for a strong USD, while on the other, the BC is poised to ease rates. Looking ahead, FX Street analysts like Joshua Gibson anticipate that early 2025 could see the U.S. dollar strengthen due to uncertainty and risk-off sentiment, potentially pushing the U.S. dollar to Canadian dollar pair towards the 1.4400 level. This longer-term view suggests a continued weakening of the Canadian dollar, especially if the BC proceeds with a faster easing cycle than the Fed through 2025. Now, let's turn our attention to the charts to see how these fundamental drivers are translating into price action. Here on the one-day chart, covering data up to September 12, 2025, we can observe the broader trends for USDCAD over the past year and a half. From around May 2024 to mid-December 2024, USDCAD showed a general upward trajectory, consistent with the reported 8.5% decline in the Canadian dollar during 2024. You'll notice some extreme candles in late 2024, likely indicating flash events or data anomalies, but the overall bullish sentiment for US dollar to Canadian dollar during that period is clear. However, a significant reversal began in late March and early April of 2025, where the pair dropped from highs around 1.43 to 1.44 down towards the 1.385 mark. This strong move lower in US dollar to Canadian dollar perfectly correlates with the news we discussed. The Canadian dollar's rebound as US data reinforced the case for Fed rate cuts. More recently, from August into early September 2025, the pair has largely traded within a tighter range, oscillating between approximately 1.375 and 1.385. This tight range reflects the market's current anticipation ahead of the upcoming central bank announcements, as noted in market commentaries. Key long-term resistance for US dollar to Canadian dollar, as suggested by analysts, lies around the 1.4400 level, which was briefly tested in December 2024. Immediate overhead resistance can be identified around 1.387 to 1.390, representing recent peaks in August and September. On the downside, initial support rests around the 1.375 to 1.378 zone, with stronger psychological and technical support around the 1.355 to 1.360 area, which held in late May and June 2025. Let's zoom into the 15-minute chart to capture the more granular movements and illustrate that recent Canadian dollar rebound. We're looking at data from September 9th to September 12th, 2025. Specifically, if we focus on September 11th, 2025, you can clearly see the price action aligning with the news. Starting from around 7:12 Universal Time Coordinated on September 11th, where USDCAD was trading near 1.38789, we witnessed a steady decline. By around 15:12 Universal Time Coordinated, the pair had dropped significantly to 1.38334, confirming the Canadian dollar rebound's headline from Kitco News. This roughly 45 pip move lower in US dollar to Canadian dollar within a single trading day underscores the market's sensitivity to the evolving rate cut narrative. For short-term traders, this timeframe highlights the importance of observing intraday support and resistance. On this day, we saw resistance around 1.388 and then support forming around 1.383. Now, switching to the 1-hour chart, which provides an intermediate perspective from late August 2025, we can see periods of consolidation and minor directional shifts. This chart demonstrates how the pair has been trading in a relatively tight range, often between 1.382 and 1.386, prior to the more recent movements on the daily chart. The tighter candles with smaller bodies suggest a period of indecision or accumulation as markets digest information and await new catalysts. These short-term ranges offer opportunities for scalpers or range-bound traders with clear boundaries to define risk. The resistance in this range held firmly around 1.386, while support was established near 1.382. So, what does all this mean for your trading decisions? From a bullish perspective for USDCAD, meaning a weaker CAD, the long-term forecast targeting 1.4400 in early 2025, particularly if the Bank of Canada maintains a more aggressive easing cycle than the Federal Reserve, presents a significant argument. Persistent global risk-off sentiment or any deterioration in Canada's domestic economic outlook could also fuel this bullish move. On the bearish side for USDCAD, indicating a stronger CAD, the recent rebound driven by U.S. data reinforcing a Fed rate cut case is a key factor. Further weak U.S. economic indicators, especially around consumer sentiment or employment, would bolster the Canadian dollar and push U.S. dollar to Canadian dollar lower. For short-term traders, the current tight range on the daily chart, roughly between 1.375 and 1.390, is crucial. Look for a clear breakout from this consolidation zone for directional trades. A break above 1.390 could quickly challenge the 1.40 level, while a move below 1.375 could see a retest of the stronger 1.355 to 1.360 support. Longer-term traders should pay close attention to the explicit language from both the Fed and the BC in their upcoming statements regarding future rate path guidance. Any divergence in their easing policies will likely dictate the sustained direction of USDCAD. To recap, let's highlight the important price levels to watch. Immediate resistance is around 1.387 to 1.390. A sustained break above this could signal a move towards 1.400, with a 60% likelihood if the BOC's easing outpaces the Fed's. Major long-term resistance is the 1.4400 level, which could be tested in early 2025 if risk aversion grows and Canada's economy struggles, presenting a 50% likelihood. On the support side, short-term support is at 1.375 to 1.378, and stronger support lies at 1.355 to 1.360. A decisive break below 1.375 is likely, 65%, if the Federal Reserve signals a more aggressive easing path, strengthening the Canadian dollar further. Look for upcoming central bank policy statements, particularly from the Bank of Canada on September 17th and the Federal Reserve next Wednesday. Also, keep an eye on fresh U.S. economic data, including jobless claims and consumer sentiment, and any significant shifts in oil prices, as these are critical for the Canadian dollar's performance. These events will be the catalysts that confirm or invalidate our projected price movements. Trade safely, and we'll see you next time on Explain the Charts.